Welcome, everyone. We have another Fireside Chat here, and we're going to be talking taxes, specifically how to save tax using the lifetime capital gains exemption. How to get the maximum benefit from that, Kevin? And first, we got to let people know what that benefit is, how much tax you can actually save.
Well, yeah, the lifetime capital gains exemption, basically it's selling qualified shares of a Canadian business, a private business in 2023 would give you a lifetime capital gains exemption of $971,190. It's a lot of money to be able to deal with. So if we want to take a look at it and use an example, let's assume that you sold shares of your corporation this year, $1 million profit is what you made. That's the capital gain. Now, without the lifetime capital gains exemption, you're going to have to, show half, $500,000 as taxable gains for what you got. Now, if we use the gain though, we take away that $971.90, that leaves us with $28,810. Now all we're showing is $14,405 of taxable income. A substantial difference for what you're going to actually have to pay on.
Yeah, if you had to claim $500,000 tax versus $14,000 tax, of course you pay $14,000. And that is a significant reduction when it comes to taxes. And that number, the $971,190, that does change every year. They adjust it 2023. That is the amount, and they're slowly moving that up to the $1 million level. That is the stated goal. So it gets bumped up every year to get to that 1 million. We should mention it is per individual, so you have to be eligible. So we'll have some text here from the Government of Canada website. You have some definitions there, but the simple version, eligible means you're a resident of Canada.
That's the big one. That's the only thing that you have to deal with. As long as you are a resident of Canada, there are some stipulations around how that works. You do qualify for the lifetime capital gains exemption, and you can use this. And remember, this is shares more of a private company. That's the way it's going to work. If you're running your own business, things along those lines, you will qualify for this. But there's more than just those sort of examples to deal with.
Yeah, that's the key one. You got to be a Canadian resident. And I should mention for your business, it has to be a business. This is not for individual items, it's for incorporated entities, for corporations. Your business has to be permanently in Canada too. You could have some U.S. portions there, those rules around that, but you got to be thinking Canadian individual, Canadian business. You could qualify for the tax exemption. It's also a cumulative amount. Meaning, let's say I had a business, Kevin, and I sold it for a capital gain of $200,000. I put $100,000 into the business, sold it for $300,000, so I had a gain of $200,000. I can get the whole thing tax-free, and then I still got some exemption remaining.
Yeah, I mean, basically that's what it is. It's not just for one thing. As they mentioned, it's a lifetime capital gains exemption. So as Clint mentioned, that cumulative scenario once. So if you sold business one, you start business two, and then maybe you make another $300,000 in profit off that. Well, if you've only used two, well, there's three. Now I'm at five, and I still have some left beyond there. So remember that it is not just for that one business you have. If you create another business and you go along those lines, you can utilize it if you still have room. And as you mentioned, those numbers are going to go up.
Yeah, so cumulative. You don't lose it. It just keeps carrying forward until you're able to use all of it up, which is good news. And then this is a key factor. If you're trying to structure a corporation, structure a deal to sell the corporation and take full advantage of this tax tool, well, you have to sell the shares of the corporation. You can't sell the assets. And let's explain this with a bit of an example here. Let's assume we go into business and we're making, what do you want to make? Want to make shoes? You want to make
do that. Widgets of some format.
Or widgets. It's always the classic example. So we're going to be making widgets. And we have a corporation, and let's say it owns the factory, it owns the equipment. Well, we can't sell the equipment itself. One of our competitors can't come along and buy the equipment. Well, they could, but we're not going to get the tax exemption. We got to sell the shares of the corporation, which holds all of that.
That's right.
In order to get the full exemption here.
And again, that has to be dealt with in regard to the business itself. I mean, it can't be, you may have the factory and all that stuff, but if you hold anything else outside, properties or things along those lines, we cannot include that in because it's more of a passive scenario. So it has to be active towards the business when we're dealing with this.
That is key, and we're going to dive into an example of that. And this does get complex, so we should take a quick reminder, folks. It's normally not a one and done. You're typically working not just with a financial planner, but your accountant, your lawyer. You want to trust those individuals, talk to those individuals, make sure your corporation is structured so you can take advantage of the lifetime capital gains exemption. So there are certainly valuable resources. Chat with those folks. And if you have questions for us, whether it's on this topic or any other, where should folks go?
They should go to chatwithclintonandkevin.com. As Clinton mentioned, this particular scenario can get very complicated. And if you want more involvement with it, please let us know. and we'll be able to contact either the right people or help you out with the right guidance to go forward and make sure that you've got that lifetime capital gains exemption utilized. So you can deal with this one. Any other topics you want financially, we're more than happy to deal with.
Yeah, and the reason we're saying accountants and lawyers are also part of this process is because if you go to the government website and say, all right, what are the details? How complex can they get? It gets complex quite quickly. Well, you touched on a point earlier. Let's go back to that here to help explain it, and we'll use that same example of our company making widgets. There's two key tests here. Well, one is the time of sale, and one is 2 years prior to the sale, and it has to do with the level of active assets in the company.
Yes.
So let's widget example. We have a corporation, like you said, where we got the factory, we got the machines. Maybe we got a good deal on the building across the street. It has nothing to do with our company.
Not at all.
But we got a good deal on it. We're renting out to making money. Nothing wrong with that. But if it's in the corporation, it's not going to be considered an active asset. It'll be considered a passive asset, which will go against us for these particular tests. Or maybe we just have a bunch of cash in the bank that's just sitting there. That'll work against us. Or we have some other investments. That'll work against us. And the keys here, Kevin, 2 years prior to the sale.
Yep.
50% has to be active assets. At the time of the sale, 90%.
That's exactly it. And again, the way to try and eliminate or deal with this so you've got it in the right perspective is to create a holding company. Because if we want to make sure and things going that way, make sure all the operating assets are in that one company where you can qualify for this. And if you have the passive assets, then you're moving them into your holding company. It's now not going to be a play on how that limited lifetime capital exemption goes for you going forward. So that's one way to sort of structure it. But again, consult accountants and lawyers before you do any of these things to make sure you've got the right scenario going on. And you're right, the 2 year 50%, 90% other scenario, that's very important to realize. And of course, there's a detailed, long listing description of that in the government website.
There is, and you might be noticing a 2 year window here. Well, obviously you need to plan for this. You can't just sell your company on a dime. What company sales tend to be a little more dynamic and take a bit of time regardless. But if you want to take full advantage of the exemption, and there are lots of tax benefits with the exemption, you need to plan ahead. You need to make sure you purify your corporation. So you take the other assets out through a holding company, and you have to have at least a 2 year window, which comes to the Becca or mantra.
Have a plan. This is the biggest factor always going forward. Don't just think that you can do it in the last minute and that it goes this way. Make sure that if this is your structure and that you want to deal with 3, 5, 8, 10 years down the road, have your plan now, get it all set up. That way it's going to make it a lot easier to have all this stuff going your way by the time it actually comes to the sale of the company. And you want to claim the lifetime capital gains exemption.
Absolutely. There's no shortcuts there. You got to put in the work. You need to have a plan. I'm losing my voice already talking about tax benefits. That's the best way. We talked high level, how you can get the best bang for your buck for the lifetime capital gains exemption, what you would need to qualify. If you enjoyed this video, we have another video on how to create multi-generational wealth. You'll probably like that one too. It's on the screen. Yeah, right somewhere there. We'll put it there. So click on that video. We'll see you very soon.
Take care.